Hello, welcome to the Bloomberg Intelligence Industrial Call. I'm Christina Fury.
Hi, I'm Mustafa Okur. I cover electrical equipment and flow control equipment.
I'm Karen Ubelhart. I cover the large cap industrials and the rental sector.
Cellino, U.S. machinery analyst.
Today we're going to talk about second quarter earnings, who's reported, who's coming, and what it all means to us. So let's get started with some companies that have already started their reporting. Chris, I know Fastenal reported last week. What were some of the key takeaways? Did you see any big surprises?
Yeah, so we've had two industrial distributors report to kick off 2Q earnings here. MSC and Fastenal, again, both short cycle industrial distributors, heavy exposure to the industrial economy, a lot of manufacturing markets. Results for both were relatively in line with street expectations, both on the top and bottom line. I would say underlying margins did come in a bit softer than we anticipated. And I think really that's more of a reflection of this slowing industrial economy that's kind of unfolding here. And essentially, the companies were just unable to adjust some of their cost structure for this slower growth environment intra-quarter. But the results really are just more of a reflection of what we're seeing on the macro front with a lot of the indices, whether it be PMI, industrial production. We're sub 50 on PMI for a number of months now. So demand is moderating. It's not falling off a cliff, but it is slowing and probably will continue to slow over the balance of the year. And that's ultimately what's being reflected. Again, very short cycle business, mostly book and turn in the quarter, so not a lot of forward visibility, more of a better indicator of current market conditions.
Got it. Now, Mustafa, I know Acuity also reported. What was your view there?
Sure, similar to Fastenal, I guess, Acuity is a short cycle company. The results were a bit of a mixed bag. We had sales down almost 6%. EPS was still up around 7%. They had a good operating margin improvement, which led to the EPS expansion. In terms of whether that is a canary in the coal mine or whether it's not, at the moment, I don't think it really reflects on the rest of the electrical equipment sector. Again, Acuity is a short cycle company. They are exposed to commercial construction. So slowdown there, the decline in commercial and industrial loans, it does affect them. And they are relatively less exposed to some of the structural tailwinds that are in the electrical sector, such as nearshoring, the shift to electric vehicle manufacturing. They have less direct exposure there compared to the likes of Eaton or Rockwell or companies like that. So I would say a bit of a more isolated case. They do have an EPS guidance, but their guidance is more of a framework. It's not meant to be updated regularly, so they kept that. They're probably on track to hit the EPS guidance of $13 to $14.50 a share. They did downgrade the sales guidance for the year, though, which came as a negative surprise because they only have one quarter left for the fiscal 2023. So that does imply an acceleration in sales decline from 6 to 8 to 9%, potentially down 10% if the sales do dip below $1 billion. So we're going to be watching that next quarter. But again, just to repeat, I don't see a similar performance for the rest of the sector simply because the other companies, the larger electricals, they have massive backlogs that they're carrying into the second quarter.
So a similar short-term dip on demand, just like Chris's coverage. Now, Karen, some of the largest multi-industrials are reporting next week, like General Electric and 3M. How do you think the quarter will play out for those companies?
Well, in the case of those two companies specifically, there are some special factors that are going to drive earnings. GE's in the middle of a breakup, and it's really two companies at this point. The aerospace side, it should be, and I think that gives them an opportunity to increase the outlook. And now that it's the second quarter, they may do that. I think they would do a pretty marginal raise if they did anything. We'll be also watching cash flow. They outperformed in cash flow in the first quarter. They have a back-end loaded guidance, and so second quarter has to contribute a little bit more. So people will be looking at that. On 3M, that's one of the companies that has a larger exposure to the consumer sector, and they had sales declines in the first quarter. They will have sales declines year over year in this quarter. And they've got, electronics, they've got some auto exposure, they've got, a mixed bag of consumer impacted companies. There's also healthcare, there's other things, but they will probably see a bigger impact from the slowdown that we're seeing in the consumer sector. They already have lowered expectations. There is a chance that they could have to do it again on those two companies specifically.
Great. And switching back over to Chris now with the larger machinery companies that you cover, what is your expectations for them?
Yeah, so I think expectations are somewhat elevated going into 2Q, especially given the recent outperformance of machinery stocks over the past 1 to 3 months. We saw, if you remember, we saw pretty broad-based beat and raises across the sector in 1Q. I think the setup heading into 2Q still remains favorable, with a normalizing supply chain, which should support higher production rates and volumes. You still have very strong, albeit moderating pricing and some easing or I guess stabilizing on the cost front. But I expect the magnitude of the beats probably to be more modest. And I think the number of companies actually raising their outlook will be fewer than what we saw in the prior quarter. As volume should moderate in the back half of the year, price cost tailwinds should also begin to subside against some pretty tougher comps. We continue to see the commercial vehicle space, so think PACCAR, Cummins, even Allison Transmission, as one of the areas that could see the biggest positive surprises in 2Q. We've seen build rates really, steadily climb throughout the quarter, and favorable pricing and should really a strong drop through there. Obviously, the focus is going to be on visibility into 2024. Order boards are essentially filled for the year for 2023. So all the focus is going to be on what kind of visibility we have into next year. We also see ag holding up quite well. So Deere, CNH, AGCO, with particular strength in North America. We've seen Brazil soften a bit here in the quarter. You've seen, moderating farmer sentiment down there, given some of the delays in the government sponsored financing programs. So OEMs have, as a result, kind of dialed back production a bit. So probably some sequential moderation in that region. And then construction, I'd say, kind of a similar setup to last quarter. Demand quite strong in North America, obviously ex-residential markets. But hearing of, more moderation in Europe and South America, and then China, which, appears to have taken another leg down in the quarter. So somewhat of a mixed bag geographically speaking. I think one thing to watch there will be inventory levels. We continue to hear of growing excavator inventories in the channel, which isn't a particularly encouraging sign heading into next year. But those are some of our key thoughts, kind of as earnings for machinery names should start up next week.
Maybe I could chip in there geographically. I agree with Chris. And on the automotive side, especially China being a bit of a softer than expected market, slow rebound this year could impact some of the early reporters like Sensata exposed to that region. And in terms of strength, we still have good demand in Europe on data centers. North America, broadly speaking, still holding up, except some soft spots like industrial connectors, for example, comes to mind that ITT makes. But in general, there is a bit of a dichotomy between Asia, specifically China, and the rest of the world.
Geographically, I would mention, I would say that the China commentary is also true for my companies. They all have, 5 to 10% sales exposure to that sector, and the recovery is coming back slower than they anticipated. North America still looks pretty good. Not really hearing much problems in Europe either. There are some slow pockets, but it isn't, I wouldn't say it's a troubled outlook. So from the regional perspective, it's still going to be driven by North America.
Just to tag on to Chris's comment about inventory levels, I know the outdoor power equipment is also dealing with elevated inventory levels, like Stanley Black & Decker and Toro, who's an off-cycle company, but their last quarter reported that they also are going to stop production to reduce their inventory levels. So inventories is hitting, I guess, across some of the machinery companies in different ways. And heading into more machinery conversation, maybe Karen, you can discuss the equipment rentals that use all this machinery. I know Herc and United Rentals are reporting next week. What do you see their outlook for the sector this quarter and then throughout the rest of the year?
I think the rental sector has one of the more favorable outlooks in the broad industrial space for a number of reasons. The activity levels are very high across the board. There are some small pockets of construction that are slowing, but you've got money starting to flow on the infrastructure bill. You've got some mega projects starting. You've got the IRA Act that's not really impacting them yet, but they're starting to see some on the inquiry level. The other thing I would say about them is they're North American plays only, so you don't really have to worry about the other regions. They are North American plays. These companies have been growing over 20% against tough comps. I think they're going to do it again, and the money is just really starting. The big money is just really starting to flow. URI, they're seeing good incremental margins on the volumes, because on top of the rental activity, they're also seeing very good rate increases. There's a shortage of equipment to rent, and demand is not showing any signs of slowing. There are periodic concerns, and if anybody misses a little bit, you may see it in the quarter, about commercial construction. But when you really break it down, the industrial sector is larger for most of these guys. They have very small residential exposure, which is the other soft pocket. As I said, the new mega projects and other things that are coming forward, I think will offset. So I actually think that the rental sector is one of the more attractive pieces of the industrial space.
Similar to that, I mean, we have the big electricals like Hubbell, mostly a North American play. The backlog actually ticked up in the first quarter despite record revenue. Also growing at high teens organic growth rates against very tough comps in Q1. Probably will see a bit of a slowdown in Q2. What Chris mentioned about running into tougher comps in pricing, for example, will come into play. But I don't think we'll see the growth rates falling off a cliff. They will still be 10% or so for the big electricals. And then on the higher end of my coverage, actually, in terms of growth, we still have Rockwell and Vertiv, which could grow at 15% or even better, because they suffered a lot from supply chain issues because they are heavy users of electronic chips. Yeah, their recovery is still sort of underway from that supply chain crunch. And then on the negative side, we have Cognex and Acuity that we've mentioned before. Cognex is exposed to logistics and market, which is having a downturn of its own because of the overbuilding of commercial warehouses, especially during the pandemic. But other than that, we don't really have big declines in our current coverage on the electrical side. So yeah, still very good growth. And then EPS growth of roughly mid-teens. There's still some price contribution. Operating leverage should be very, very good, record output levels. So yeah, things are on the North America side are still looking very healthy for electrical equipment as well.
That's great. And I know you also cover the flow companies, and I think Dover's reporting next week. Any insight into what you're looking out for when they report, or any of the other flow coverage you have?
Yeah, I mean Dover is still facing a bit of a tough comparison point for their pumps unit, which is very high margins, 30% plus. Until that recovers, which will be in the third quarter or so, when the COVID-related production comparisons ease, they will have slow EPS growth. Within the flow space, Pentair is also an interesting name. We're watching that name closely. We have a focus idea on it. We think that the consumer-related spending, which shows up in their pool segment, should see a bottom by the end of the third quarter. Underlying demand has actually been okay there. It's just the channel, the distributor channel had a bit of a buildup in inventory. So the sell-through has been good, but the sell-in into the channel has been quite weak. We're going to be watching commentary around that. So are those trends still continuing? Is the sell-through still strong? Is the sell-in into the channel still falling or stabilizing? So we'll be watching for signs around that for in the second quarter earnings.
Very interesting. Is there anything else that our investors should be looking out for, maybe this quarter or throughout the rest of the year?
I think there's going to be confusion on the order backlog situation, and that is because many of the companies have excess backlog. As the supply chain is easing, they're able to get more production out than they expected, so we might see some beats on the top line, but that will mean backlog has the potential to start to decline as you get that layer of excess backlog shipped. Also, the order rates, they're going to slow a little bit because of what we're seeing in some of the in some of the regional economies, but also the tough comps are still there. So you've got potentially slower growth in orders, maybe even some declines at some of the companies, but I think it's more slower growth on the order side. So incoming is slower and outgoing is faster. Backlog will start to fall. So people, how do they read that? The excess backlog, like Fortive said, they have about $300 million in excess backlog. If they ship a decent amount of that, is their business slowing? No, they're normalizing their backlog. But how that is interpreted by investors will be one of the more interesting parts of the second quarter, I think.
Yeah, I'd agree with Karen's points there. And obviously, any kind of visibility into 2024 early order trends. A lot of the OEs in the machinery space have been restricting or limiting order books. So we haven't gotten a lot of color yet on 2024. So that I think is going to be certainly in focus, as well as pricing of 2024. We're looking at kind of more of a normalized pricing environment into next year, but still want to see price cost positive for most of the names, and then inventory levels again, particularly against that backdrop of peaking backlogs and falling orders. Both new and used equipment inventories continue to build almost universally across the machinery space. So need probably a little bit more color and commentary around managing those inventory levels against that, falling order trends to help support some of the recent outperformance we've seen in the machinery space. And then obviously anything incremental on the macro front, customer cautiousness, signs of orders being deferred, that obviously would be top of mind, particularly with many of the machinery markets we think are at or very close to peakish type levels. And then maybe lastly, I'd say, downside mitigation efforts into next year. What kind of decremental margin framework are we looking at in a downturn scenario? Is there potential to see, higher trough type level margins next year, given some of this, the strong pricing and elevated backlogs?
I mean, on the electrical side, Rockwell Automation tried to telegraph this message of falling orders when they reported last quarter. It's a September year end, so they said fiscal 2H, order intake will be roughly 4.2 billion versus 4.8 billion booked in fiscal 1H. The market seems to have taken that okay so far. The company is still trading about a 1 standard deviation above its historic premium to the market. Dover has been telegraphing this message for a while now as well. Their order intake has come down actually, or started to come down for a while. But yeah, I agree with Karen's point. It's also, I guess it depends whether the declines start to accelerate meaningfully on the order side or not. But so far, from the few companies that have either shown their orders coming down or mentioning that they will come down, market has taken it okay thus far.
I would just add one thing. I don't expect big raises, even for those that beat. That happened in the first quarter, but they don't raise in the first quarter. In the second quarter, I think you'll see the same because people do have second half concerns. So those that beat, for example, Honeywell always beats by a little. You know, they may raise by that amount, but I don't really expect any meaningful EPS raises in this quarter. People shouldn't forget about tough comps on the top line. That's going to be a big factor. And one company that I would watch in my universe for similar to the distributors is Parker Hannifin. 70% of their business is still industrial. A lot of it is short cycle components, and people will be looking at North America and international, which is largely Europe, the order rates in those two regions. Aerospace is going to be very, very strong for them. However, it's 30%. So the industrial still kind of drives the story. And that will give some signaling to the broader industrial sector, just as the distributors do.
Great. Well, there's so much to look out for now. Thank you so much for all of your insights. That's all the time we have for today. Thanks again.